In this video, I'll demonstrate how an add or drop decision is arrived at under relevant costing. Let's go through the question. Kantanka Company Limited manufactures 3 types of cars. We have Eroka, Wafo, and Nantier. Data on sales and expenses for the past year are given below. So when you go through the financial statement, you realize that the net operating income for the entire company is 60 Ghana cedis. And then among the 3 lines of business, it is only Eroka that is making a net operating loss of 15 Ghana cedis. Additional information. The general factory fixed cost and depreciation were allocated on the basis of sales. Management is concerned about the continual losses shown by the Eroka division and wants a recommendation as to whether or not the line should be discontinued. If the Eroka line is dropped, the 2 line managers will be discharged of their duties. You are required to determine whether production and sale of Eroka should be discontinued. Okay, so in arriving at a decision to add or drop a particular division or line of business, we have 2 alternatives. Okay, we have 2 ways of going about this particular dilemma. So I'm going to demonstrate each of them for you. So first of all, we have alternative 1. Alternative 1 says that if you drop a particular division or a particular product or a particular line of business, you are going to lose that particular division or product or line of business's contribution. So you are going to lose the contribution. And then you are going to save the avoidable fixed cost attributable to that particular division. So alternative 1, if you want to use alternative 1, then it means that when you want to drop a particular division, you are going to lose the contribution from that division. And then also you are going to save the avoidable fixed cost pertaining to that particular division. Contribution, as you may already know, is the selling price minus the variable cost. And the avoidable fixed costs are costs that will not be incurred if you drop a particular division. Okay, so they are costs that the company will not continue to incur in future if they decide to drop a particular division or a line of business or a product. So drop Eroka. We have our Ghana cedis here. And using this approach, we say we are going to lose the contribution pertaining to that particular line of business. So let's refer back to our question. We realize that the contribution that is coming from Eroka is 80 Ghana cedis. So if Kantanka Company Limited decides to drop Eroka, okay, or decides to discontinue this particular line of business, it is going to lose the contribution of 80 Ghana cedis. So we will represent it as a negative figure because it is a loss. Then you less avoidable fixed cost. These avoidable fixed costs, like I said earlier, are the fixed costs that the company is no longer going to incur if they decide to discontinue or to drop a particular line of business. So let's go back to the question and identify the avoidable fixed cost. Under fixed cost, we have advertising, traceable. If you say something is traceable, it means we can attribute it to a particular cost center, and so it is avoidable. It means that if we stop or if we discontinue a recast, we are not going to incur an avoidable an advertising cost on a recast. Then we have depreciation of special equipment. Depreciation is a sunk cost. It is not an avoidable cost. Then we also have salaries of line managers. Salaries of line managers. In the additional information, we are told that if the Erica line is dropped, the 2 line managers will be discharged of their duties. Okay? So based on that, we can say that the salaries of line managers is avoidable, because if the company decides to drop Erica, it means the 2 line managers are no longer going to be paid salaries. So it is an avoidable fixed cost. Then we have general factory fixed cost. These general factory fixed costs are allocated on a predetermined basis. Okay, so they are unavoidable. They are unavoidable costs. So from our question, we have identified that there are only 2 avoidable fixed costs. That is advertising and salaries of line managers. In respect of Erica, we have avoidable cost for advertising of 41. And then also for salaries, we have an avoidable cost of 6. So in using this approach, we are going to save those avoidable fixed costs. So first of all, we have advertising. It is traceable. Advertising cost of 41. And then we also have salaries of line managers of 6. So we sum the 2 up and we are getting 47. We are going to less that from the contribution lost. When we do that, we are going to get an amount of minus 33. Mind you, the contribution is a negative. So it is negative 80. And then we are lessing avoidable fixed cost. So negative 80 minus 47. And that gives us 33, because the minus will become plus. Okay, so the negative 33 is the decrease in net operating income. This means that if Kantanka Company Limited decides to drop the Erica line, there is going to be a decrease in the net and in operating income by 33. Okay, so let's refer back to our question. The company has a total net operating income of 60. And so if they decide to drop the Erica line of business, this 60 is going to decrease by 33. So now the new net operating income for the company will be the 60 minus the 33. And that will give us a new total of 27. because dropping EROCA will lead to a negative effect on the net operating income for the entire company. It means it will not be prudent, or it will not be advisable to drop that particular line of business. So the advice is that they shouldn't drop EROCA. They shouldn't drop EROCA because it is going to have a negative impact on the total operating income for the entire company. So this is the first way, or the first approach in tackling a question of this nature. The next alternative is to recast or to redraft the financial statement, excluding the statement in respect of the division that has been discontinued. So we are going to re-prepare the financial statements, but now we are going to exclude the dropped division or the dropped line of business. So we are going to prepare a new financial statement for the company with the exclusion of the company or the division that has been dropped. So drop EROCA. Now we only have Boafo and Nantier, so we have a total we have Boafo here and Nantier. We are not including EROCA because here we are preparing the financial statement again, having in mind that we are dropping EROCA. So we start with sales. We are just re-preparing the financial statement again. So let's go back and refer to the question. We have sales of 140 for EROCA, 500 for Boafo, and 360 for Nantier. But now EROCA has been dropped, so we only have sales for Boafo and Nantier. For Boafo we have 500, and for Nantier we have 360. That gives us a total sales of 860. So we have 860. We have 500 here and 360 there. Then we less variable cost. Let's go back. The variable cost for Boafo is 200, and that for Nantier is 150. So we have 200 and 150. That gives us a total of 350. So after lesson, we have a total contribution of 510. For Boafo we have 300, and for Nantier we have 210. This is the contribution. Then we less fixed cost. We have advertising. That is traceable. Advertising cost for Boafo is 110, and that for Nantier is 65. So we have 110 and 65, and this gives us a total of 175. Then you also have depreciation. We are told that depreciation is allocated on the basis of sales. Depreciation is allocated on the basis of sales. Since depreciation is not an avoidable fixed cost, it means the total fixed cost of 95, it is going to be allocated between the remaining lines of business. So we are going to allocate the total 95 between Boafo and Nantier based on their sales. So for Boafo, the calculation is, because the total depreciation is 95, and then we are going to calculate it based on, we are going to allocate the depreciation based on the sales volume. For Boafo, we are going to divide its sales of 500. So for Boafo, it will be 500 all over the total sales of 860 times the total depreciation of 95. Okay, and this will give us a depreciation charge of 55 in respect of Boafo. And for Nantier, the total sales is 360. So we divide by the sales for Nantier is 360. You divide by the total sales of 860. Then you multiply by the total depreciation of 95, and that gives us an amount of 40. Then we have salaries. Salaries of line managers. These are traceable. For Boafo, we have salaries of 7, and for Nantier, we have 6. So 7 and 6. This gives us a total of 13. Let's go to the next page. Then we also have general fixed cost. We have total here. We are continuing from where we left off. So total here, Boafo and Nantier. Ghana cedis, Ghana cedis, Ghana cedis. Since the general fixed costs are unavoidable, okay, the total general fixed cost of 200 is still going to be paid, but now it is going to be shared between only 2 lines of business. Now that we are deciding, if you drop a recast, it means Boafo and Nantier are going to share the general fixed cost of 200 Ghana cedis. And we are told the allocation is done on the basis of sales. So we have a total of 200. We are doing the allocation on the basis of sales. We know Boafo has sales of 500, and the total amount of sales is 860. So 500 out of 860 times 200. That gives us a general fixed cost in respect of Boafo of 116. Then for Nantier, we have sales of 360 out of the total of 860 times the general fixed cost of 200, and that will give us a figure of 84. So now we sum up all the total fixed cost. So we had the total, we sum up this, and that. That gives us a total fixed cost of 483. And in respect of BAFO, we have 110, 55, 7, and 116. And that gives us 288 in fixed cost. Then we have for Nantier, we have 65, 40, 6, and 84. When you sum all of them up, we have a figure of 195. So now we determine the net operating income. The net operating income. We are going to determine it by subtracting the total fixed cost from the total contribution. So now we have a total contribution of 510. Let's subtract the total fixed cost of 483 from that, and that gives us an amount of 27. Then in respect of BAFO, we have total contribution of 300. If you subtract the total fixed cost of 288 from it, we get a figure of 12. Then for Nantier, we have total contribution of 210. When you subtract the total fixed cost of 195 from it, we have a net operating income of 15. So when we redraft the financial statement, or we reprepare the financial statements, excluding the product line we are dropping, we have a total net operating income of 27. Remember earlier we had a total net operating income of 60. That is when Eruka was not dropped. Okay, when Eruka was part of the business, we had a net operating income of 60. And now after dropping it, the company is going to have a net operating income of 27. This 27 agrees with the 27 we had here. So you can use either approach to solve this particular question. And because dropping Eruka is tantamount to a decrease in the net operating income, it is not advisable to drop Eruka. Because it is going to have a negative impact on the net operating income of the whole company. Thanks for watching. This is the end of this tutorial. Kindly subscribe to the channel, comment, like, and share. Have a nice day. Bye for now.